Hey guys, it's me. In today's video, we are going to be covering the top 5 investing mistakes that every beginner investor makes, but more importantly, how to avoid them so that you can start investing in the stock market without losing money. Let's get right into it. Now, trying to time it. This is by far the biggest mistake that all investors make, and quite possibly one of the most common mistakes throughout human history. The desire to time your investments perfectly is a dangerous mindset that can cause even the smartest investor to make irrational decisions. You see, timing the market means you're trying to predict future stock prices and basically trying to beat the market. But here's the thing, no one can consistently predict what the market will do next. Not Warren Buffett, not your neighbor Joe who just got lucky with GameStop, and definitely not that random guy on YouTube. Even if you could somehow predict the market perfectly, you would still have to time your buy and sell perfectly as well, which is incredibly difficult because once you buy, you have to then decide when to sell. And once you sell, you have to decide when to buy back in. Essentially, you're trying to make money from predicting something that is completely random. But there's good news. There's a very easy solution to this problem. And for beginners, I recommend you use index funds. Index funds allow you to instantly diversify your investment over hundreds or even thousands of companies in just one single investment. They are passively managed, meaning that there are no actively managing the fund to try and beat the market, which is a good thing. This allows you to invest and then forget about it, while still being able to take advantage of the growth of the overall market. So instead of stressing out about whether or not the stock price is going to go up or down in the next week, you can just enjoy the fact that you own a small piece of some of the largest and most stable companies in the world. Number 2, investing without a plan. Have you ever gone grocery shopping without a list? If you have, you know that you end up buying a bunch of stuff that you do not need, and then you end up wasting food because you bought way too much. Well, investing without a plan is kind of like going to the grocery store. Without a list, you'll probably end up making some bad choices that will cost you a lot of money. Before you invest in anything, you should first ask yourself 2 questions. 1. What am I investing for? And 2. When will I need the money? These 2 questions are crucial because your answers will dictate what type of investments you choose. For example, if you're investing for retirement, you can afford to take on much more risk than someone who needs the money in the next 5 years. After all, you have decades until you need the money, so you can ride out any short-term volatility. However, if you only have 5 years until you need the money, you need to be extremely careful because the stock market can be extremely volatile in the short term. A sudden crash could wipe out thousands of dollars from your portfolio and force you to sell off your investments at a loss. Therefore, before you invest any money, make sure you know exactly why you're investing and when you will need the money. This will make a huge difference in what types of investments you choose. No. 3. Not diversifying. Imagine you're playing a game of basketball where you get to pick your teammate. Would you rather pick someone who has never played basketball before or someone who has played their entire life? Hopefully, you would pick the person with experience because they are less likely to mess up and cost your team the game. Now imagine you're about to invest in the stock market. Would you rather invest in a company that has been around for decades or a brand new company that just started last month? Hopefully, you would invest in the company that has been around for a long time, because they are less likely to suddenly disappear and cost you all of your money. Unfortunately, most beginner investors don't think like this when they invest in individual stocks. Just because a stock might be growing really fast doesn't mean that it's a safe investment. Companies can, and do, go bankrupt all the time. Take for example, Kodak, a company that was founded in They invented the first consumer camera and dominated the film and photography industry for decades. However, they failed to adapt to changing technology and filed for bankruptcy in 2012. This means that if someone invested in Kodak stock in the early 1900s, they would have lost all of their money. This is why it's so important to diversify your investments. By spreading your money around, you reduce the impact that any single company could have on your portfolio. This means that if a company goes bankrupt, you won't lose all of your money. The other companies in your portfolio will hopefully still be growing, and you can continue to make money even though one of your investments failed. Nope. Buying on margin. Buying on margin is when you borrow money from your broker to buy more stock. It's kind of like taking out a loan to buy a house, except with stocks. You can buy as much as you want. You also won't get kicked out of your house if the stock price drops. That sounds great, right? Well, yes, it does sound great, but buying on margin is extremely risky. Here's an example to show you why. Let's say you have $1,000 and you want to buy 100 shares of Company X. However, Company X is trading at $15 per share, which means you can't afford 100 shares. So instead, you buy 50 shares and borrow $500 from your broker. Now let's pretend the stock price drops to $5 per share. Even though you still own the same 50 shares, now they're only worth $250, which means you lost $250. But remember, you also have to pay back the $500 that you borrowed, bringing your total loss up to $750. That's right, you lost more money than you even had in the first place. Now imagine if the stock price drops even further, to $1 per share. You would owe your broker $450 more than your investment is even worth, meaning that you would have to either sell off your shares at a massive loss or default on your loan, which will destroy your credit score. Needless to say, buying on margin is extremely risky, and I strongly advise against it. No. 5. Investing emotionally. Do you hold your favorite team's fantasy football draft party every year? Do you get super excited when your favorite team scores a touchdown? Or do you get mad when they make a bad call? Well, if you answered yes to any of those questions, then you know how powerful emotions can be when it comes to investing. Emotions can make you buy high and sell low, which is the exact opposite of what you should be doing. When the market is down and everyone is scared, you should be buying. When the market is up and everyone is greedy, you should be selling. Easier said than done, right? Well, yes, it is easier said than done, but it's not impossible. You see, it's extremely important that you don't let your emotions control your investing. To prevent yourself from making emotional decisions, follow these 3 steps. 1. Never invest money that you need in the short term. This way you won't be forced to sell off your investments during a market downturn because you need the money. 2. Only invest in things that you understand. If you don't understand a stock, bond, or mutual fund, then don't invest in it. This will help you from making irrational decisions based on hype or fear. And 3. Consider dollar cost averaging. Dollar cost averaging is when you invest a fixed amount of money at regular intervals, regardless of the stock price. This way you won't be tempted to buy high or sell low. Instead, you will be buying more shares when the price is lower and fewer shares when the price is higher. I hope this video has helped you avoid the most common investing mistakes made by beginner investors. If it has, please hit the like button. I would greatly appreciate it. Thank you guys so much for watching, and until next time, take care.